Hello traders, this is lesson number 4. We're going to talk about going long with options. So let's get into it. Okay, what does long actually mean? If you go long an option, it means that you are buying the option. When you buy something, you need to pay for it. So when we buy an option, we pay for the premium. The nice thing about buying options is that you can control the risk up front. So there are 2 types of long. You can go long call if you're bullish, or you can go long put if you're bearish. Now, let's try to understand why we would use long options instead of just buying stock. We get the example of Apple stock that is trading at 180. If we buy the stock, let's say we buy 100 shares of it, at 180 price, we're going to pay $18,000. So let's say the stock moves up to 190, so we have a $10 profit. Our actual profit will be $1,000, which is more or less a return of 5.5%. But what if instead we decide to buy a call? So we choose the strike for the call we buy at 180, so where the price is staying today at the money. It's going to cost us $5. That's the premium we need to pay. If you remember, one contract is equal 100 shares. So what we're paying is $500. This $500 are our maximum risk, which means if we were wrong about Apple moving up, the max amount that we can lose is $500. Doesn't matter if Apple tanks. Now, let's say instead the stock moves higher, moves to 190, like the previous example, and the option value goes up to $9. We made $400 of profit, which is a return of 80%. This is great because we capitalized on the same move. We needed much less capital. I mean, the difference between $500 and $18,000 is massive. And our risk is always going to be $500 no matter what. Let's talk about when though long options make sense. So the best conditions for going long options is you need to have a very strong directional bias. So you need to be very sure about the direction. Obviously, nobody knows what's going to happen in trading, but based on your analysis, you have a strong conviction that the stock is going to move up or down if you're using puts. We need to be in an expansion phase, not a choppy environment. So we need to have a strong market, strong sector, strong stock. We don't want a stock that goes up and down in a range like chopping. Also, we need to know where our analysis will be wrong, the level at which we know that we're wrong. And very important, we need to expect that move in the stock to happen fast. That's when you buy long options. You need to expect not only a move up or down, it has to happen fast. So we need to avoid sideways markets or low volatility environments. So environments where stocks are not moving much, because we need the stock to move and to move fast. Okay, so let's look at the structure of a long call. We said it's a bullish trade. So you're betting that the price goes up. This price needs to go up before expiration. You all remember that options have expiration dates. Obviously, we want the stock to move before expiration. And the move needs to be big enough to overcome the premium that we paid. That's pretty obvious. Again, we go to the risk. Instead, is limited to the premium paid. So if I pay $500 to buy this option, that's my maximum risk. It doesn't matter where the stock is going to end. Let's go step by step through an example. Okay, we have again our Apple stock. It's currently trading at 180. Our directional bias is bullish, and our target, let's say because of previous moves or a supply demand zone or like previous resistance, is 190. Okay. Now, what we do practically, we open an option chain. So we select the stock. That's Apple stock. We select it. We open the option chain. You can open your option chain in every brokerage. Interactive Brokers, Schwab, Thinkorswim, TradingView. Then the first thing you see is the expiration dates. So we said that we need the stock to move fast because we know that time decay is devaluating the option with time passing. So when we buy long options, we need to buy enough time. Why? Because if we decide to go long on option and we just have 1 week to expiration, the theta, the time decay, will be so big that even if the stock moves in your direction, the whole value of the option will be eaten by the theta, by the time decay. So what we buy usually is 30 to 45 days out. So let's say today is the 23rd of January. We buy like 1 month. We buy or 1 month or 45 days out. So in this example, we bought the May 23 long option. So we gave ourselves a lot of time to have this theta as small as possible. It's not gonna affect negatively our option position. So let's say we go 23rd of May, then we open the option chain here. We decided to buy a call because we're bullish at a strike of 180, which is basically where the stock price is now. So we are at the money. When you're at the money, it means that you're buying the call at a strike that is basically almost the same as the stock price currently. So we select the strike 180. We go to the bid and ask. So usually we shave the spread, which means that if an ask is 510 and the bid is 5, you should go in the middle. Let's say 505. For this example, to make it easy, we have a $5 option premium that we're going to pay. Okay, so when you buy an option, you go to the ask. Obviously, when you sell an option, you go to the bid. We said that one contract is 100 shares. So with $5 times 100, that's our cost, $500, and our max risk. Now, I cannot repeat this enough. The risk here is defined. $500 is your max loss. Because of this, because it doesn't matter what happens to the stock, maybe tomorrow Apple tanks, you don't need a stop loss because you're not going to lose more than $500. This is a great thing about options. You don't need a stop loss. You're not getting stopped out. You're not getting whipsawed by like up and down moves. Your risk is redefined, and that gives you a lot of peace of mind. Now, how do we make the profit? So the stock, Apple stock, moves from 180 to 190. So in the direction that we predicted. So if it moved there at 190 to our target and it did it fast enough, let's say in the first week, it already moves to target. So if we bought a call for $5, the option value when the stock gets to target increased to $9, the profit per contract, very easy to calculate. So it's 9 minus 5 times 100 is $400. So you've seen the power of option. You can spend very little money and have control on a stock that will cost you thousands of dollars. Now, the stock has no expiration. Options have expiration, but you need much more capital and there's a slower return on investment. If we buy long option, our risk is defined. So we can decide, okay, how much I want to risk. Am I comfortable with this number? That's the max number I'm going to lose. Perfect. You need less capital. Imagine instead of spending $18,000, you're just spending $500 to make a profit in a few days. That's the downside, is only this time sensitive. So we need to be right, not only on direction, but even on timing. So we need to buy option, long option, only when there's a high volatility, there's a strong trend, and we have a stock that moves enough. So on the next lesson, we're going to talk about the same concept of with puts. I hope everything was clear. If you have any question, drop it in the comments. Thank you so much, and I'll see you next time.